Okay, there are some commonly used trading strategies, which is strategies are more like not just one call or one put. I'll try to do some combinations of them. Sometimes that may result in more profit or lessening of the loss or whatever it is. So I may be more interested in doing some kind of combination, just like a portfolio. I would like to get into a portfolio of options itself, right? So there are some commonly available strategies. One called as a straddle strategy, where I will get into buy one call and buy one put of same strike price. That is what is the funda behind the straddle strategy. So the strike price should be the same, right? And I am trying to get into buying one call as well as buying one put. So now I can say market price, call. See, because I am buying one call as well as buying one put, I will have to have the profit relevant to the buying of a call. So there is one call and one put. The combination of those two is what is my profit or loss. So in a simple way, we know individually this is one call, this is one put. So my combined profit will be the addition of these two numbers. If I had bought one call and one put of both the securities, right, of the same strike price, then I know what is going to be my profit or what is going to be my loss. So let's say here, so which is as good as, probably if I try to add it up here itself, or we'll put up one more thing where we'll take up right again from 2050. Because this is the same strike price, I can use the above one itself. Let's say for these prices, one straddle. When I say one straddle, it's a combination of one call plus one put. Right? It's a combination of one call plus one put. So my profit is nothing but, I'll say equal to I can very well say this plus this. Very straightforward. So my profit here is becoming 459.19, and I'll drag it down. So this is what is going to be my profit. Now what I can very well do is I can simply plot a graph. Again the same line chart. This time again I can edit the chart. I will remove the market price from here. I will edit it here, and I will put the values of this. Now you are seeing that this is how the straddle is looking for me, where it's like a V shape. Now just if I extend the data a little bit more, even my profit also will go up in the same direction. So what we are typically seeing is it's a V kind of a shape. I mean, here also it extends. We have taken the data only up to 3000. So it is stuck up to here itself. If I take it up to 3200 or 500 kind of stuff, even the values, even it comes like a perfect V. So what are we talking about this perfect V? When the stock price is lying between 2500 and probably here 3000 something, I will have loss. But when it is beyond these numbers, right, if the stock price is within this range, if the stock price is within this range, my profit is actually negative below the x-axis. So I'll have negative. But the moment it is outside the range, I'm going to get good profits. So if I assume that the stock price is going to be very much volatile, I can adopt this strategy. Now just try changing this number from 28 probably to 26 or something. Now you see my straddle looks more like this, a proper V, a much better V, right, where it is saying as long as the stock price is between 2.5 and probably 2.7 or 2.750, as long as it is in between that on the final date, I will see that I will have a negative value or I will have a loss, but that loss is also minimum, only to this extent. Whereas if the stock price is fluctuating on that day, anything less than 2,500 or greater than 2,750, I can make enormous profit on that. So what we can typically look at in all these strategies is, okay, is this a better strategy or some other strategy we need to look at, so that at the end my risk needs to be mitigated and probably the return should be much higher for me. So like this, there are so many strategies that are available in the market, right? Straddle is one such kind of a strategy where I really think, when will I use it? When the market is very volatile and the direction of the stock price is unknown. So I am sure that the stock is very volatile, but it may fall down or it may go up. See, like before a budget, or right before some general elections or some kind of, or before an annual general meeting of the company, I may say if the result is positive, if the result is good, the stock price will rise like anything. If the result is bad, the stock price may fall like anything. So I am very much sure that on that day there will be a lot of volatility, but in which direction, let's say, I don't know. Even if it goes in either direction, I want to profit out of it, I can choose straddle, because in straddle I am getting a profit. Profit is the upward side. I am getting the profit. In case of simple call, I am getting a profit only if the stock price rises. In case of put, I am getting a profit only when the stock price is falling. Whereas in case of straddle, I am getting a profit in either directions, even if the stock price is falling or if it is growing. But the growth has to be phenomenal. The change has to be phenomenal. So especially this is typically called as a volatility strategy, right? If the stock is very fluctuating, heavily volatile, I will try to adopt this kind of a strategy. So for each of the securities, by plotting these kind of graphs, we can very well see which of them is a much preferred kind of a strategy in each of the scenarios. So similarly, just like that straddle, we have a few more strategies where, I mean, at the end of the day, you can adopt your own trading strategy, but these are most commonly available kind of strategies where, okay, there is one common strategy called strangle, where I say buy one, call, high strike price, buy one put, low strike price, not the same strike price here, low strike price. This is what is a strangle strategy. So which means I am actually buying one call and one put, just like a straddle, but both are of not the same strike price. Both of them are two different strike prices. That is what I call it as a strangle strategy. Again, a similar graph you can try to construct for the straddle also, straddle as well as strangle. Similarly, probably you can try one of those, right, either now or even at home. Or there is one more strategy, which is the most common, which is another common strategy, where I'll say spread strategies. These are called as spread strategies, where I say buy one call, high strike price, no, high. You can have anything. All four combinations are possible. Sell one call, low strike price. So here I can have four combinations. So buy one call, low strike price, sell one call, high strike price. Similarly, call replaced with put. All four combinations are possible in spread strategy. So there are four different spread strategies. So we'll try to execute one of these, or probably I'll have one more most common strategy called as a butterfly strategy, where we say buy one call, low, or buy two calls, one low and one high strike price, sell two calls, both at the same strike price, which should be exactly in between the two buy prices. So there are four things that we are doing here: two calls and two puts, or two buying two calls and selling two calls. But all of them are different in strike prices. At least there are three different strike prices. The first and the third, and the middle one should be exactly in middle between the two. It's like this. If I buy one call, with 2-4, if I buy one call with 2-4, another call with 2-6, then I have to sell two calls exactly at 2-5, which is in between 2-4 and 2-6, which is exactly in the middle. So that is what I have tried written here. Buy two calls, one at a very low strike price, let's say 2-4, the other at a very high strike price, 2-6, and sell two calls both at the same strike price, which should be exactly in between the two buy prices, 2-4 and 2-6. The exact in between of that is 2-5. Now we'll try to write the payoff for this strategy. Once you are able to write the payoff for this strategy, you can very well do it for all the securities. So let's try to draw for this the market price. When we say payoff, we will draw it exactly the same way. Or before we draw the market price, because we have different strike prices. So low strike price, medium strike price, and high strike price. These three need to be equally distributed first of all. So let me say here it is 2-4, 2-5, and 2-6. This is what I mean by equally distributed. The gap should be uniform between all the three. Whether the gap is 50 or 100 or 150, it's immaterial, but it has to be uniform. 2-4, 2-4, 5-0, 2-5. You can do like that. Or 2-4, 2-5, 2-6. Any of these combinations are pretty much acceptable. Now you can use your VLOOKUP to get the call option price for these three. You can get the call option prices. So we'll simply say VLOOKUP this value, comma, do it on this entire column, this entire range. And for me, the last traded price is in the G column. So 7, 0. So this is what is my, this is what the thing I can write for all the three. So I will get, this is the premium for all these three strike prices. Okay, now that we have these three prices, now I need to have a scenario which will talk about, okay, I buying a call at 2.4, right? Selling a call, so probably I can do it with respect to a buyer itself, put a negative for a seller, right? And similarly, so probably I should do for these three scenarios, 2.4, 2.5, 2.6. So let me put market price, right? We'll take the same numbers again, 2000, 2050, right? Just to get a better graph, I'm taking so many values, otherwise it's not required. Okay, so from 2000 to 3000 I'm taking all the values. So I'll say the first call, whatever is the value, I'm not writing the, or probably call 1, sorry, yeah, probably lower call, lower strike price, medium strike price, and higher strike price. Probably even you can call that way also. So just because if we write the number explicitly, if I change the numbers here, it will become a problem. So that's where I am keeping a general naming there. Now, with respect to the call 1, we can very well find out what is the payoff, right? Just like this logic here, just the same logic which we have written here, I can write it here also, which is probably just for a brush up again, the max of, I'll either have the negative of the premium, comma, the market price minus the strike price minus the premium. This is exactly the same thing which we have done in case of the call in the first. Market price minus the strike price minus the premium. And I'll put appropriate dollars. Strike price we got this one, 77 point, 2400. Minus premium. Premium we got corresponding to that 77.6 or whatever you got. So this should give you a value of something. Before that you can put dollars for all the non-repetitive things. 2.4, wherever that 2.4 and 77.6 are there, you can put the dollars for them. So you should get a number equal to minus 77.6 in the first case. And when you are dragging it down, these are the numbers. From minus 77.6, it should go up to 522.4. Got it? Now you can very well execute the same for call 2 and call 3, where I am saying the maximum of market price minus the strike price minus the premium, comma, minus premium. Put appropriate dollars. put appropriate dollars. Similarly, you can do a call 3 where you are also saying again the maximum of the market price minus the strike price minus premium, comma minus premium. All three the same. So these should be your numbers. Just try out on these. Yes, so now at the end I can very well talk about one butterfly. One butterfly is nothing but one by one this one by this one by this two cell. That is what is the butterfly. Right? As we said, buy two calls, one low and one high. So I want to buy one of this, and I want to sell two of this. So the payoffs also, wherever it is buy, I just add up the numbers. Wherever it is sell, I put a subtraction. So here I will say equal to, the first one is buy, so I will put this, plus the third one is also buy, I will put this. The second one, there are 2 units of sell. So I will put minus 2 into the middle one. Minus 2 into the middle one. That's it. So this is what is going to be my payoff. I can drag it across. This is what is going to be my payoff. So in this case, I can start looking at this diagram. Now I will plot a chart with this value. I press the control key and select this value. Or probably we'll draw a plain chart, that is much easier. Without selecting any data, you put insert a line chart. So you will get a plain chart. Now on this plain chart, just simply do a select data. It's as good as earlier we have selected the data, we got some default chart plotted, and from there we started removing. This is another way where I start with a blank chart and add only the things which I really want. Okay, so here I'll add, the first one I'll add is one butterfly, whose values are these values. And I'll edit the horizontal axis, whose values are these values. So this is how my butterfly chart comes up. So it actually looks like a butterfly. That is where they have named it. The chart or the see the calculation, what we are saying is, now what did I talk about the butterfly here? This is the thing which I said, where buy two calls, one of a low strike price, so buy this one unit of this, buy 1 unit of this. Sorry, buy 1 unit of call 1, buy one. So just go with this statement, buy two calls, one low and one high, means this one and this one. This one and this one I want to buy, and this one I want to sell 2 units of this. So whichever are the things that are to be bought, I'll simply add those numbers. So this number plus this number, whichever need to be sold, I'll try to subtract. No, call 1, lower and higher I am buying. Lower and higher, lower is call 1, higher is call 3. And the middle one I am selling. That too 2 units of that. So as long as I expect that the stock price will lie between, let's say, 2400 odd to 2500 odd, I can make profits. Otherwise, I am losing into a loss. So if I really think that the volatility is much lesser, the stock will not fluctuate at all. It's a very conservative stock. It does not fluctuate much. The better strategy for it is to go for a butterfly, because it does not fluctuate much, right? So I'll make a profit only when the fluctuation is very less. It's just opposite to a straddle. If you see, straddle wise, I can make a profit when the volatility is very high, whereas the butterfly wise, I'll make a profit when the volatility is very less. So I need to have a mechanism now to find out the volatility. We have already looked at standard deviation as a mechanism to find volatility, fluctuation. So if that particular security's standard deviation is very, very less, I will prefer butterfly strategy on that options. If the standard deviation of that security is very, very high, I will prefer a straddle strategy on that. Right? We have computed the volatilities, or for Infosys, we looked at standard deviation and all those numbers. If the standard deviation is a very high number, right, very, very high is typically, for an annual data, if it is anything more than 30-40%, right, if it is at least 30%, anything more than 30% on an annual data, I look at it as high. But if it is around 5% to 10%, we'll look at it as much lesser. So whenever we see a particular stock's volatility is much, much lesser, we will typically adopt a butterfly kind of a strategy. Otherwise, we can adopt a straddle kind of a strategy. So like that, for each of the strategies, if I start plotting this kind of graph, at the end, the logic is very simple. For a call, I'll find out that price. That what is the profit I will get. For a put also, I know what is the profit. These two, if you are comfortable, first of all, the first two. For a call, what is the profit? For a put, what is the profit? Now, depending on how many calls I am purchasing, or how many puts I am purchasing, or how many calls I am selling, I will just add up those numbers. If it is a call purchase, I will add. If it is a call sell, I will subtract. Similarly, put purchase, I will add. Put sell, I will subtract. So like that, people have created so many names. Just like this is called as a butterfly because the shape looks more like a butterfly. Right? They have given this as a name as a butterfly. So like that, there are so many names that are given in the market. But for all of them, the only way to make out, now in this case, just let me change these three numbers here. Just to test it out. Instead of 242526, I'll make it as 2550 and 26. All are equally spaced. This is what is the number that is coming out. So what it is saying, as long as the value is in between this, I'll make a profit of almost 43 rupees. Right, 43 rupees. Otherwise, I'll have a loss of around 7 rupees. So which means here if we see, in the whole range, my loss is not more than 7 rupees, 6.95. But if the stock is within this very narrow range, I'll make 43 rupees profit. So my profit is either 43 or my loss is either 7. Probably looks slightly on the positive side. Okay, if you make a profit, you will make 43 rupees profit. If you go into a loss, you will lose 7 rupees. Slightly more encouraging. Right? It's not equally packed. On one side, profit is looking more higher compared to a loss. Whereas in the earlier case, if you see, 242526. You see, profit and loss are almost at the same number. The loss is 49, maximum profit is 50. Not that encouraging. If I get a profit, I'll get 50. If I get a loss, I'll lose 49. Not that encouraging. Whereas in this case, probably 2550, much encouraging. Right? If I get, I'll still get the same 43 or whatever. But if I lose, I'm losing only 7. A very highly encouraging sign. So compared to the same, though there are two butterflies, one with 242526, one butterfly is with one butterfly is with 2550 and 26. Out of these two, the second one is looking much more encouraging because the loss has directly come from 49 to 7, whereas the profit has come only from 50 to 43. Just the 7 rupees compromise on the profit, my loss has come down drastically. So in between these two strategies, in between these two butterflies, I would prefer the second butterfly itself. So once I have this kind of a model in place, this is what is one of my model. Because when I say a model, I just need to change a few values and I have to see the entire impact running up. That is what we typically call as a part of any financial model. You just change one or two values or few values. The entire calculations need to be taken care of and the final value also need to be given up. That is what we are calling as a simple model. So these are different kind. Once I build some kind of such models, I can very well look at which strategy is a more and more beneficial strategy here. By just by changing, probably another combination I will change. 2550, 26, 2650. Yeah, even more encouraging. If I lose, I lose only 2.25. The profit is 47.5, 47.75. Much better compared to the previous situation. Right? With there it was loss of 7 and profit of 43. Here loss is 2, profit is 47.75. Much more better. So once I have this, otherwise I have to look through all combinations separately to find out which one is more profitable for me. But if I have such kind of a model built up, I don't need to look back. Here itself I can adjust the numbers to typically generate which is more profitable compared to the other one. Fine.